Welcome to Penrose Learning, where we make understanding easy.
You begin by clarifying your objective. Are you seeking revenue, a hedge, or ESG exposure? Because that directs vehicle choice. Next, pick the market. Utilities contracts, water rights, specialized ETFs, or commodity futures. Each has different liquidity and regulation. Open a brokerage or exchange account that supports water-linked instruments and deposit the funding amount you commit. Once done, set risk limits and position size rules. This ensures you can trade immediately without guessing next steps or over-leveraging. You now analyze both fundamentals and charts to time entries. Examine supply drivers, reservoir levels, drought outlooks, and regulatory changes, and then overlay technical indicators like trend, volume spikes, and support or resistance to refine timing. Decide your order type based on liquidity. Use limit orders in thin markets and market orders when you need immediate fills. Allocate position size to your 1% equity risk rule and place stops where technical structure breaks. This controls downside while letting winners run. You finish by managing exits and documenting outcomes. Use trailing stops or scale-out rules. Take partial profits at 25%, 50%, 75%, so you lock gains while staying exposed to upside. Continuously monitor news feeds for policy shifts, weather events, and corporate reports that can rapidly change valuation. React by adjusting stops or rebalancing. After closing, perform a post-trade review. Log P&L. Note what worked and update your playbook. If positions misbehave, tighten stops and reduce size to troubleshoot execution or signal issues.
Thanks for watching. If this was helpful, leave a like and consider subscribing. See you next time.